Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So, had a request in the comments the other day to do a reaction video to Chicken Genius Singapore's video on value investing is dead. So that is what today's video is going to be all about. I'm sure you're already familiar with this guy's channel, but if you're not, definitely go check it out. I'll leave a link in the description to both the original video and to the channel as well. I actually had the chance to travel to Singapore in late 2017, so very cool part of the world. But there were sort of a few critiques, I guess, in that video of value investing, and I think a lot of them are kind of common misconceptions. So I'm keen to give you my thoughts on that. Pre-warning is there's probably going to be a lot more that we agree on than what we disagree on, but nonetheless, let's get into the video, and I hope you enjoy it. So please hit like on the video, but I hope you enjoy. Let's get into it. Got my coffee all ready to go. Hit like, always support your YouTubers, hit like on the videos.
Hey, hi friends. Warren Buffett, he just finished his AGM, I think about a week ago. I will summarize the entire 4 hours meeting and I give you my take behind Warren Buffett. So this guy, he trailed the S&P 500 for the last 5, 10, 15 years. Ouch. He was actually asked this question during a Q&A and I really cringed for him. I will also cover why, in my opinion, value investing is dead. So firstly, I will need to define what is value investing. So let's go Google it. What is value investing? On the top of the search, Investopedia. What is value investing? Value investing is an investment strategy that involves picking stock that appears to be trading for less than their intrinsic value or book value. I'll explain this later. Value investors actively ferret out stocks, means they filter out stocks which they think the stock market is underestimating. So this is what it means. Value investors like...
So this is probably the first bit that I disagree with, and I have a feeling that this is where a lot of the confusion comes in, I guess, with value investing, because value investing is quite a broad discipline, and there's many different kind of streams within that of value investing. So for me, as far as how I define value investing and how I know a lot of the modern sort of Warren Buffett followers, I guess, would define value investing is as simple as buying something for less than it's worth. So that doesn't necessarily mean that you're just buying the lowest PE stocks or the lowest price to book stocks or any sort of single statistical metric like that. There's certainly investors that do that. Someone like Tobias Carlyle with his acquirers multiple comes to mind with that. But really we're trying to look at what's the future earning power of this business, and therefore what's an intelligent price to pay for it. And I don't think that way of operating is going to go anywhere, to be frank. So that's the first thing I'll mention.
Discounted stocks, things which are cheap. Because things are discounted, they swoop in for the discount. I'll show you roughly how they do it. So we are looking at this thing called book value. So there's one method where we can do stock screening is we go to Finviz. You go finviz.com, is free, this screener. So there's many tabs here. You go to screener here. And what you need to do is, because you are a value investor, you click the fundamentals of a company. And there's this thing called P/B, which is price to book ratio. Okay, so basically for a value investor, their criteria, it has to be like around under 1, which is good. So anyway, if you look at...
So again, I don't agree with this as value investing. There was definitely the old school kind of Ben Graham way of doing it. And I think I'm probably going to agree that this method is a little bit outdated for a lot of the more modern businesses. But Warren Buffett has definitely paid up for businesses in terms of price to book. He's paid many multiples of book value because it's intrinsic value that truly matters. Book value in a lot of cases is irrelevant. So
the results that come out, there are about 1,900 companies which has a book value of less than 1. So inside the top few, which have over here, you see a lot of familiar names. We have Berkshire, is number 1 here. We have ExxonMobil. You see a lot of financial companies, you see a lot of oil companies, you see a lot of banks. Basically, mostly financial industry, which is the banks and energy companies. Maybe let's go page 2 and see what we see. Again, financial and energy, it goes on. Maybe one in the middle, tomato ketchup. We also see car companies like General Motors here, and I think on the first page we saw Toyota. So this is how value investors, they search for discount and they swoop in for the stock because it's cheap. By the way, I really appreciate your effort for helping me click the like button. It really helps a lot for the YouTube algorithm. It pushes out the video to more people.
Helps the
so what is
YouTube
price
algorithm.
to book?
I agree.
I'm just going to put it very simply. Let's say the company is worth $1 million on the stock market, and the company owns like $1 million worth of machinery. Maybe this machinery is used to produce items. Okay, so $1 million worth of assets and the company is worth $1 million. That is price to book of ratio 1. Usually on the stock market, the price to book ratio is above.
That's generally true. You'll also have to take into account any debts. So if that same company also had $500,000 in debt, then their book value is 1 million minus $500,000, which is $500,000. And if they're selling for $1 million in the stock market, that would be a price to book of 2. But largely that's the logic you got to follow. Its book value is essentially just equity. There are some slight different definitions with book value versus equity, but for the most part, assets minus liabilities.
Above 1. So suddenly, let's say we have a few companies where the price to book ratio drops below 1, it is cheap. Let me give you an example. Let's say, for example, the same company has $1 million worth of machines making products, and one day the company, the value drops to 800,000. That gives us a price of book ratio of 0.8. With the price to book ratio of 0.8, you are effectively buying the company at $800,000, but you are getting $1 million worth of equipment. The biggest problem with that is what's valuable to this company may not be valuable to another company. And let's now talk about some examples. Remember when Tesla bought over, I think, the General Motors factory, there were a lot of car equipment inside there. The thing is, whatever General Motors used to produce the car is worthless to Tesla. So those equipment...
Yeah, this is something that was really common when Ben Graham was originally doing a lot of his sort of net investing and even going in and liquidating companies, and Warren Buffett did a little bit of that. If you had a company with $1 million in book value, for example, through, let's just say it was pure machinery, for that investment to work well, you would need a much larger discount than probably about 20%. You're looking to buy at much more dramatic discounts than that. Really, because the reason is when you liquidate a company, it's a fire sale. You're not going to get back exactly what you paid for those machines. You're going to have to sell things at discounts as well. So you really want a discount to the discounted price, if that makes sense, when you're trying to buy into those types of companies. But this is very much sort of old school value investing, I would say, for the most part.
Practically worth nothing. Or let's put another example. Let's take banks, since there is a lot of banks inside this discounted place here. So banks, how they calculate price to book ratio is basically the amount of assets they own, blah blah blah, so on. So they maybe include property and some companies. You see, when a bank goes bankrupt, let's say for example, this current property will be on forced sale. That means they will auction out the property. It may not translate to what it is on the actual paper itself. And let's say if the
so far I agree with a lot of what this guy's saying.
Even worse,
yes.
The company's equipment is almost zero because it's worthless to another company who may want to take over the company assets. So again, price to book ratio is very, very skewed. Not on paper it seems good because whatever you can value the item, there's a value to it. But the biggest problem is when it actually happens, when a bankruptcy happens, you are not going to realize the actual value in the price to book. Don't get me wrong, I super respect Warren Buffett. He taught me plenty and there are things that are still relevant. But most things is outdated. Times change, things change, and most importantly, we grow and learn. Since we are talking a lot on the banking and financial industry,
I think if you're working with smaller amounts of capital and you're not working with the hundreds of billions that Warren Buffett is, a lot of these methods can still work. And and there's pretty good guidelines out there for how you should go about valuing a company if you're going to use like a liquidation value type approach, like we're talking about here. So book value is a nice kind of screen to sort of pick up some companies that might be candidates in the first place. But ideally you want to assign, discounted values to each of those for what you can realistically liquidate the company for. So obviously, if the company has cash, you're going to get 100% of that cash if you were to acquire the whole business. And then it's sort of working through each of the individual major assets that company owns and putting a realistic price on what you think you could get for them. So book value is a nice screen, but it's not the end all and be all. And really, you're going to have different discounts to what you can eventually liquidate the company for, depending on what type of assets they own and what the business is. If it's a lot of real estate, you're probably going to get much closer to what the book value is versus a company that owns highly specialized machinery or something like that.
Banks as an example again, with the lack of growth and innovation. You see, there's close to zero innovations in the banking sector. If you look at China, on how everyone, including the beggars, are using like their mobile phone for digital payments, everybody is doing it. One day, somebody is going to come along and innovate past the other banks all around the world. Digital payments is the place to go in the very future. You do not see traditional banking moving into the digital sector where they will help out with payments. I think this is going to be the next disruption. Anyway, I began to ask myself, what ensures the company's growth? I begin to ask myself relevant questions. You see, copyrights and patents won't protect a business.
I have nothing special to add on the payment sector.
The long term. There is only one thing that protects a business, which is innovation. You keep innovating and your competitors can't keep up. What Warren Buffett does is look into boring, simple businesses. Yes, they may have some kind of
yes and no. So I think if you're someone like Tesla and you're trying to win the electric car game, innovation is absolutely something that's going to keep you ahead and protect you. I think if you're all of these things depend on the business. So I think if you were someone like Coca-Cola, who has a product that has worked very well for over 100 years with not a whole lot of changes, I don't really think you need to innovate all that much to continue to do really well. So sure, Coca-Cola is acquiring other businesses which produce different kind of drinks and all that sort of thing, but if Coca-Cola went ahead and started spending like half their earnings on trying to develop new Coke like they have done in the past, it's been proven that is generally quite unsuccessful. So certain businesses yes, certain businesses no, just depends on the types of companies that we're looking at for innovation.
Mode. But if they fail to innovate, one day somebody is going to come along and disrupt them. Let's cover what I disagree first. These are the points which I disagree with Warren Buffett inside the AGM. He says to buy a cross-section of America and forget about it. He basically means buy the S&P 500 and forget about it. S&P 500 is the index of America, so when you buy into the S&P, you buy into 500 companies. I disagree that because the thing is, there's this thing called value traps. Like just now you saw within the screener itself, there are oil companies. It's like catching a falling knife. A knife is falling and you want to catch it. That is like super dumb. The thing is, investing in index, overall, I do agree that it's kind of safe, but within the index itself, there's a lot of value traps. And to me, if you are an educated investor, I would probably like to nitpick on the companies which I think is amazing and avoid all these other value traps.
Yeah, so I agree. If you know what you're doing, and you're keen to put in the effort to pick individual companies, that can work very well long term. When you're buying an index, you buy everything. So yeah, you are going to get some poorer quality companies in there that aren't going to grow into the future, but you're also not going to miss the things that grow at massive rates for years and years. So that's kind of the point of buying an index. You don't do really well, but you don't do really poorly. And if you don't do poorly and you're saving a reasonable amount of money over time, you should do quite well. The
next point is that Warren Buffett sold in April. You know, April was one of the best months for the stock market. It is crazy. I don't agree with him. Actually, I did a video on this, on why I think the market will keep going upwards. I'll link it up here and I'll put it in the description below. But he sold in April, which the markets went up like one of the most bullish times in the stock market. And he did the exact opposite. This is the oracle of investment, the number one guy in the world, and he sold in April, where I was telling everybody to buy. Warren Buffett.
Good on you, mate. But look, I mean, he kind of said it. Like, Warren Buffett's the best investor in history, and you know, he was selling in April. No one can time the market, I think. You know, you can obviously look at dramatic falls and make a reasonable assumption that there's a highish probability of being a bounce up after that, but you don't make investment decisions on that. We look at individual companies. If the individual companies have good prospects moving forward and they're available at an attractive price, you make that investment. If not, then you don't. And the reason that Buffett sold in April, that wasn't any kind of market call. That wasn't looking at, you know, I think the S&P 500 is going to be up next month or down next month. That was a decision on a very specific, select number of businesses, in this case the airlines, which have had a very rough period. Basically, it was a mistake. Buffett has admitted that was a mistake on the probabilities, you know, that he estimated at the time of making the investment, sort of 2 or 3 or 4 years ago. He liked that bet, but obviously there's been a worldwide crisis since that time, which has disrupted the businesses massively. So yeah, I think that. I don't know if that point is proving very much, to be frank. So that's that one.
This is cash position to 130 over billion. I think it's 138 billion in cash. Hello? The central banks of America, the Fed, they already said that they will print unlimited money and do whatever it takes to support the stock market. Why are you keeping all that cash? You see, all that cash is going to go into the bond market and generally spread all around. Eventually, all this cash will trigger some kind of inflation. And I actually did cover again in my past videos that this inflation will occur in the stock market. Warren Buffett.
Yeah, so I don't really have any opinion on inflation. It's a bit of a weird one. Like, there was so much money printed in 2008. Interest rates have been low for a very long time. And really, we've had very little inflation, and no one can kind of seem to explain why that is. So, but outside of that, I think Buffett would probably agree that it's not intelligent to have that much cash over a long period of time. Ideally, they would be close to fully invested, pretty much at all times. With keeping a little bit of reserve available for their insurance businesses, because they do have to keep a cash cushion for that should there be some, you know, hurricane or mega catastrophe where they have to pay out a lot of money immediately to cover that insurance liability. So you do have to remember that Berkshire are an insurance company and they do have to keep some cash around. But nonetheless, cash drag and not having money invested over the long term is a very, very poor decision. So look, the fact of the matter is that cash pile is built up over a period of time just because there haven't been enough attractive opportunities in the mind of Buffett. There's probably been many attractive opportunities out there, but Buffett has to find something that he understands, and it also has to be at the scale that Berkshire Hathaway can put a lot of money to work with. So, you know, he really can't invest in a business unless it's at least 50 or 100 or, you know, a trillion, 50 or 100 billion dollars in market cap, or even closer to $1 trillion in market cap. He can't get a reasonable amount of money into businesses unless they're that large. So that leaves quite a small number of companies available for investment to him, and you know, within that he's got to understand it, and it's got to be discounted. So there's many kind of variables in there that make investment opportunities more and more rare, kind of the larger that Buffett gets. So but I would love to see Buffett put that cash to work. I agree with you there 100%.
Also said that the airline's CEO was doing a great job when he purchased into the stocks. I mean, hello? The airline CEO, now we all know this whole thing about CEOs doing the share buybacks is a stupid idea, and the thing is, he's still defending share buybacks. That is so old school thinking and very, very irrelevant. The reason why money goes into share buybacks is that because the CEO doesn't know what to do with the extra cash. This is what he is practically telling the world. Hey, I don't know what to do with my extra money. I will just do share buybacks. Again, I couldn't disagree more with Warren Buffett. I believe the extra cash, if you could use the money, should go into innovation. And again, either you innovate or people will disrupt you. Now let's go to the part where we agree.
So I don't really have too many comments on the airline CEO stuff, but on share buybacks, I've done a video on this just a couple of weeks ago. I think it's an incredibly misunderstood topic, and it's really very simple. If you don't have anything to do with the cash, which a lot of businesses don't. I mean, again, if you're Tesla or some rapidly growing company that is in the technology field and you're having to innovate, absolutely go ahead and do that. If you're a business like See's Candy that Warren Buffett owns, your product hasn't changed for many years, but your sales have still been incredible and you're just printing money. It's a phenomenal business, but it doesn't have opportunities to grow. They've tried to grow it in a lot of different ways. They've opened stores in different countries, even within different states in America, and it just hasn't worked out. But their current business, that they have managed to scale, is doing very, 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 very well, and it's printing a lot of money. So there's really no option other than to return cash to shareholders for that particular business. Now that's a business that Buffett wholly owns, but when you see that happening in the public markets, that leaves basically dividends or share buybacks. So if you can do a buyback at a reasonable valuation on the stock, great decision. If you can't, dividends are probably a better option. So I tend to agree that a lot of dividends are done at pretty overvalued prices, and there's definitely some CEO incentive stuff built into that. But if done well, they can be very, very beneficial for shareholders.
He said two things which I totally agree. So the first part is never bet against America. I totally agree that. And Americans and America, you guys are so innovative because of your culture and stuff. The things that you come out with, the rest of the world copy, especially freaking China. So the thing is, I do not want to bet against America. The S&P 500 has been going up for the past 140 years. I am quite certain it will still go up at least in the next 10 years. Yeah, I have nothing else to say on that. So the next point, he sold all airlines. That is a good move. You realize when your investment thesis is wrong, sell. You have to do that. You cannot keep hoping and hope the stock go up. Hope is not a strategy. And of course, the last point, I agree, and I showed this in my previous video. You see, this is what he said, and I really 100% agree him. I couldn't agree anything lesser than him. When you buy a stock, you should be prepared financially and psychologically to hold them. You have to be prepared to buy a stock and have it go down 50% or more and be comfortable with it. So let's say, for example, you buy a stock and it drops 50%. You have to be really comfortable because of this thing called, you did your research, you know exactly the company, what their outcome is in the future, and the stock market is being stupid. You have to be mentally ready for this. Okay, you see that he said, if you can't handle this psychologically, you shouldn't own stocks.
I agree with that completely. The other thing I would add is if the stock does go down and the story's changed, I think just because it's down shouldn't be a reason that you don't sell. If you've made a mistake, you've got to kind of take that on the chin and just admit it. But by and large, if you're still confident that the company is going to do well and the stock price has just come down a lot, there's no reason you should be selling that.
This is the thing. This is something that I teach all the time, and you have to understand that whatever he said, the reason why an investor like me and a lot of successful investors, we are able to be level-headed when shit happens is because the amount of work we put in. No amount of money can buy that kind of conviction that I have in Tesla and the stocks that I buy. Concluding this video, what we learned in the investing world, we can apply to our daily lives. People who are willing to keep learning, growing, and generally have a positive mindset will do better. Hey look, I don't mean to ask you to be positive one day. It's not a one-day thing. It's a long game that we play. You see, Warren Buffett is a legend, but like all legends, if you fail to innovate, you will be left behind. Just like Berkshire Hathaway.
Yeah, so this is something I probably should comment on. So I believe that if you gave Warren Buffett $1 million today and that's all he was managing, he would absolutely like destroy the S&P 500. So what we're looking at here is Berkshire Hathaway versus the S&P 500. And Berkshire, again, you have to make a few considerations for this. So firstly, they have had a lot of cash on the sidelines and they haven't put that to work because there haven't been opportunities. And, you know, even since Buffett has been investing in like the 60s. If you go back and read his letters from the late 1950s and the early 1960s, even when he was working with small amounts of capital and cranking out just ridiculous rates of return, he made it very clear that in long bull runs or in very extreme kind of upward markets, that he would be quite likely to underperform even when he was at that level. So it doesn't surprise me that Berkshire Hathaway have had the same thing happen. I think Berkshire will do far better than the market in down markets, and we can see a little bit of that in the 08-09 kind of crash on this chart. But yeah, that's what I expect. The other thing is, like I mentioned earlier, they're at such scale now that their investment universe is a lot smaller. So again, I would expect slower growth as a part of that. And Berkshire Hathaway has an investor base where they have far more investors than the average company that have a very high percentage of their net worth in Berkshire Hathaway stock. A lot of people treat it like kind of a savings account and have done for a number of years. So they also have to be a little bit more cautious and I guess not chase the high flyers and that sort of thing, which I don't think you should be doing anyway personally, but that's another thing to keep in mind. I still think Berkshire will do well long term.
Next for so many years despite tons of resources. There's no excuses for that. Appreciate those who helped me with the thumbs up. You guys are really awesome. Invest safe.
So there you go. That's my whole thoughts on the, is value investing dead kind of topic. I do hope you enjoyed it. I think there's a very common misconception out there that value investing is just buying low PE, low price to book, all that kind of stuff. Really, it's low price to intrinsic value, which is what we're hunting for. And I think all intelligent investing is value investing at the end of the day, which is a quote from Charlie Munger. I think that you can certainly justify even Tesla as a value investment, in the sense that you're trying to buy more earnings power than what is reflected in the price. So if you think Tesla is going to perform extremely well in the future, then the price today may well make sense based on your assumptions. So I think pretty much anyone that makes those sorts of judgment calls, if they're paying X price today and they're going to get all this great earnings power in the future, that is a value judgment, and I think we're all value investors if we're paying even the slightest attention to that. So those are my thoughts. I hope you enjoyed the video. If you did, hit like, hit subscribe, and I will see you in the next one. Cheers.